Hello and welcome back to Intertax Learning. We're talking about part 2 of the requirements of U.S. tax resident individuals. Let's start with a quick refresher of our first video. You're welcome to go back to that video to review more in detail. We talked about how an individual could be treated as a tax resident if he or she is a U.S. citizen, a U.S. permanent resident, or someone who passed the substantial presence test. But even if the substantial presence test is passed by meeting the 183 days threshold, the individual could still apply for the closer connection exception by meeting all 4 of the below requirements. And then we went into this example of how a UK citizen could be considered also a US tax resident. However, as his current days in the US is less than 183 days, with all the other facts and circumstances surrounding his life, he could claim the closer connection exception. That's where we wrapped up. Let's back up a little bit. What if his current days in the US is 190 days? It exceeded 183. Therefore, he runs into the dual residency issue. For the 2026 calendar year, he'll be taxed by both the UK and the US on his worldwide income. And therefore, he runs into the dual residency issue. For the 2026 calendar year, he will be taxed by both the UK and the US on his worldwide income. At this point, his last resort is to look to the tiebreaker rules of the tax treaties. What is a tax treaty? It is an agreement between 2 countries that prevents people and businesses from being taxed twice on the same income. It lays out which country gets to tax specific types of income, so taxpayers aren't paying more than they should. If you'd like to explore tax treaties, you can go to the IRS and pick any countries listed here. The US has treaties with many nations in the world. Going back to the tiebreaker rules, there are essentially steps of a ladder that determines tax residency when there's a conflict. First, does the individual have a permanent home in either country? If not, or the individual has a permanent home in both countries, then we ask, where's the person's center of vital interest? Now, center of vital interest looks at an individual's connection in the country. If connections are in both countries, then we look at the individual's habitual abode. Habitual abode analyzes rhythms of life. Like if you have a habit of going to this country and doing something there every weekend. This happens very often in European countries, where one person could be living in a city near the borderline. He or she lives in one country but works in another. If it can't help to determine, then we look to the individual's nationality. Most of the tests stop here. However, if the individual's nationality is not one of the 2 treaty countries, then we look to the mutual agreement of both tax authorities. All right, today we talked about the dual residency issue and the treaty tiebreaker rules. In the next video, we'll talk about how multinational corporations structure their entities worldwide. I welcome your thoughts on this topic. Subscribe if you'd like to learn more. Thanks for watching. I'll see you in the next one.